As I'm looking towards next week and the beginning of the earnings season, we're seeing all of these warnings from companies, cautious tones from CEOs, but the markets are at record highs. What is the disconnect? And should investors be concerned about that?
Yeah, I mean, the disconnect right now is trade, and trade's having a significant impact on the tone of these CEOs on their conference calls. So, in my opinion, these earnings calls are going to be much more important than a 25 basis point Fed rate cut, which is really what's been driving the market over the course of the last few weeks. When you pay attention to really what you're hearing on these calls, CEO confidence has been trending down over the last several quarters. It didn't sound all that hot last earnings season. And without confidence, they can't execute on their plans. So what we need to hear out of these calls is we need to hear some commentary on the trade war. Is the impact getting worse? Or is it maybe more manageable than they initially expected? And the most important thing we need to hear out of these calls is we need to hear a positive tone shift from the CEOs. And beyond that, obviously, we need to see good results, get strong guidance, because if this quarter is weak or in line, I doubt the market advances from here. Most of the gains this year have come from multiple expansion, and if sentiment begins to sour, I don't see that continuing.
So if that theory plays out, and if the market doesn't have much more room to run from here, are there alternatives to U.S. equities? Where would you be looking?
There are no alternatives to U.S. equities.
Okay.
It's a Tina situation where there's no better alternative. I mean, equities look really cheap relative to bonds. So the equity risk premium right now is over 300. When that's been the case in the past, forward 12-month S&P 500 returns have been over 12%. So it really is the ideal situation for generating returns. What you need to do is you need to be selective. So you need to identify companies where you love their long-term growth story. Maybe you don't own some of them because they're too expensive, so you sit there and you wait for an expectations miss. As long as their long-term growth story doesn't change, you're going to get the pullback you've been waiting for. You'll get your opportunity to get in. An example of one that we've been waiting to get into that we don't own yet is Lulu. I mean, we love the company, we love the execution, we love the growth story, love the brand loyalty, but it's been expensive. If we can see an expectations miss from a company like that, we'd be hopping in.